Joining us now to talk about strategy, about how we should be interpreting what's taking place from the central banks is Peter Schiff. He's the CEO of Euro-Pacific Capital. Also still with us in the studio is Sue Noffke, fund manager from Schroders, and our guest host Jeremy Stretch, executive director for CIBC. Peter, let me kick it off with what you have to say about the ECB. You were just saying, well, we shouldn't be worried about getting into a stage of deflation in Europe.
Yeah. The idea that the problem in Europe is an absence of inflation is ridiculous. You know, if you're going to define inflation as rising consumer prices, the slower they rise, the better. In fact, if consumer prices were to fall, that would be better. So you're not going to solve any economic problems in Europe by creating inflation. You'll exacerbate them. What Europe needs, same thing as what America needs, is less government, fewer regulations, less government spending, less government debt, less social welfare programs, and more free market capitalism. That's what's going to solve the problems, not trying to paper them over by printing money. Depending on how much inflation we have, no? I mean, you can't have pure deflation,
sure you can.
Or you wouldn't have growth. No, you could. The natural consequence of a growing, vibrant economy is that prices come down because economies find more efficient ways to produce things, and the price of goods comes down. I mean, that's what happened in America from, 1870 to 1913. Prices were falling rather sharply every year, and we had tremendous economic growth. And you can even look at industries. The fastest growing industries are where prices are coming down, not where prices are going up. Look what's happening with cell phones or computers. Prices come down every year, and consumers buy more because they have more purchasing power.
I mean, I'd agree with you that Europe does have an immense number of structural problems, and clearly all of those issues that you've mentioned are endemic as part of the solution to the Eurozone's problems. But I think the issue is, of course, that this perception that if we are going to see disinflationary pressures, the ECB are very mindful that that will just further compromise consumer psychology, which I guess is the important point.
But those aren't pressures. You don't feel pressure when the things that you need to buy become less expensive. That's relief. Falling prices are a relief to consumers. What pressures consumers is when costs go up, when you have a rising cost of living. So the ECB is going to complicate the problem for the European economy by making things more expensive. You don't grow your economy by destroying the value of your money.
But I mean, in the context of what we're talking about today, I think we have to remember is we're talking about a 25 basis point cut, which, as Charles Goodhart said, is not a game changer. Yeah. Well, and we're not yet talking about the outright printing of money in the same way that we've seen in any number of other jurisdictions. I guess the question that obviously markets are very mindful of is this perceptional parallel that continues to be rightly or wrongly drawn with Japan. And
yeah. Well, the thing is, though, rates are still too low, and you have politicians relying on central bankers to try to solve the problems that they created. And now they go on making these problems worse. We can't look to central banks. We have to look to government. These are legislative problems. They need to look at all the regulations and taxes that are destroying their economies and focus their efforts there, not relying on some central bank monetary cure that is not going to work.
In essence, you're sort of throwing up the debate that the UK has about its relationship with Europe in terms of the rules and regulations which are burdening business and actually undermining the whole process about the membership regime.
Let me put this debate just to one side for 1 second and just bring you into this, Sue, as well, because from an actual investment strategy point of view, how should we be investing at the moment?
Well, I think markets still are very, very driven by liquidity events, and I think you've seen that demonstrated today with markets rising around prolonged monetary easing in Europe, only to take some of those gains back and more when the US data was stronger than people had anticipated, bringing back that tapering onto the agenda.
Yeah. Do we take profits? If you've seen a rise and you're at multi-month, multi-year highs on equities right now, I mean, how long can that go on for if we are looking at trouble in the Eurozone?
I think equity markets have run some way over this year and the last 3 years, really on the back of easy monetary policy. Yeah. What we need to see is some traction into company earnings coming from better economic data. We're getting some of that better economic data certainly in the United States. We're not getting that yet in Europe, but valuations have come up higher. Yeah. So I think we are in a trickier environment for making money in the short term. I think longer term, there's still the potential. I still believe that earnings will come through.
Yeah, I don't think we're getting better economic data out of the United States. Yeah, we're spending more borrowed money, but that's not good economic data. And the Fed's not going to taper. In fact, I think the ECB just helped them out because they're going to be able to use this as an excuse not only not to taper, but to increase the monthly dosage of QE, which is the first thing probably that Janet Yellen is going to do. That's going to be her big policy change, is more QE. And because the euro is now fallen against the dollar, that is going to allow them to do that. But what we're seeing in the United States is not economic growth. It is the euphoria that is the short-term effect of the monetary stimulus. But when that wears off, just like any other drug, you have a hell of a hangover, and the U.S. is headed right back into recession. In fact, we're headed for a worse economic crisis than the one we had in 2008. So don't be fooled by the rising stock market or the increase in real estate prices. None of this is attributable to genuine economic growth.
Okay.
The real U.S. economy is deteriorating.
Well, I think it's fascinating that you're mentioning about that Janet Yellen would bring in more QE, because if we're talking about a 25 basis point move from the ECB being a game changer, then I think that really would be a dramatic game changer. I don't really see that scenario playing out whatsoever.
Well, I think it will be a game changer when the world comes to grips with the real predicament that we're in, that we have a phony recovery that is completely dependent on ever-increasing doses of QE. So people are waiting for the Fed to take away the punch bowl. They're going to spike it even more. And that is going to be a big game changer when people figure it out.
And meanwhile, they're also talking about whether the ECB, one of the tools that the ECB could use, is some type of QE as well.
Indeed. I mean, that's a possibility. I'd say it's a likelihood at this particular junction. That's very much more the nuclear option to get to that sort of scenario. But clearly we're in an environment. I'd agree with you that we have got a drug in terms of monetary injections and liquidity, and I think we've been having this debate on the desk about QE infinity, or how do you ever roll back QE because of this liquidity injection and how we're reliant upon that. And certainly if you look at the S&P index over the course of the last 3 or 4 years, you can see the spikes correlating well with the bouts of QE. So you can say, well, how do we get out of this? And it is going to be a very slow and protracted
the problem
process.
for the Fed, the Fed wants to pretend that they can take away the QE, yet the economy can keep recovering. It can't. The minute they remove the QE, we're back in recession, which is why they're never going to remove it. But they have to pretend that they're planning on removing it. They can't acknowledge that it's here forever, because that will accelerate a dollar crisis, which is coming eventually anyway. That's the only thing that's going to end the QE. It's going to be when the market puts a stop to it by bringing the dollar down. It's not going to be the Fed tapering.
Okay.
They'll never do that.
Sue?
I think this is a very interesting debate. What I see from the companies that I look to invest in are very strong finances, but a lack of confidence about deploying that money to real effect in real business decisions. And I think that quantitative easing has given consumers and businesses time to build up some confidence, and I would expect to see some of those assets be deployed. IPO markets going well. Takeovers are at all-time highs in the United States, not in Europe. But those things can be self-feeding into a virtuous cycle rather than a vicious cycle.
Yes, no, I think that's absolutely right. It's that transition from this perception of what might happen tomorrow. It could be worse, so I will sit on cash and leave it on my balance sheet because I don't know what to do with it. I could hand it back to shareholders. That's another alternative. But ultimately, to grow the business, I need to be investing that. Now, but to have the confidence to do that does take a fairly.
It may have done something, investor confidence. Maybe some consumers who have stocks or real estate, they have a false sense of confidence because the Fed has succeeded in inflating the paper value of that wealth. But the vast majority of consumers are hurt by quantitative easing because all it does is make food more expensive, or it makes their utility bills go up. So the average American is seeing his wages, and certainly in other countries that are doing this, look what's happening in Japan. Real wages are falling as the Fed creates money. Yes, it makes asset prices go up, but that doesn't help your economy grow. Just because somebody says that you have a higher price on a stock, it doesn't mean there's new capital investment in the economy. It's not creating goods and services. It's not producing jobs.
Sue, final word from you. Where would you be investing at the moment, or where do you see value?
The question of where value is, I think, is a very good one. I think there's still value in the consumer names around the world. And I think there are pockets of value still within financials that are cheaply valued against their history.
Sue, thank you very much for being with us. Sue Nofke, fund manager from Schroders. Peter, thank you to you as well. Peter Schiff, CEO of Euro Pacific Capital. Incidentally, before we let you go, Peter, William writes in and he says, to Peter, I came from the U.S. 2 years ago to invest in Spain. I'm now leaving for the reasons that you state. Too much government intervention, which leaves companies on the margin, compression due to social programs and welfare. I'm going back to the U.S. But that's Spain.
He's not going to find any refuge there. He should go east.
Well, there is a difference between also, I mean, where you are in Europe, right?
Yeah,
so
well, it's a matter of degree.
Yeah, yeah. Right.